What did we do with DAR? We're going to take a quick look at a recent adjustment we made on a married put position in the Fusion portfolio at RadioActiveTrading.com just prior to earnings. Our situation: we have a low risk married put position in DAR. Earnings are coming out on March 2nd, just after the market closes. The stock had been down in the past couple of weeks, but moved up in the last 2 days prior to earnings. We're holding the 65 strike put on DAR as protection, but with this movement upwards just before earnings, we have an opportunity to do 2 or more adjustments on the position. What was the position? Well, on March 2nd, DAR is trading at $67.50, bouncing around between $68 and $67.50 or so. We own 100 shares of DAR at $62.51, and we're holding an April 65 put 45 days away that we paid $6.30 for. Now, our total cost into the married put is $68.81. That's our break even at April expiration. We're guaranteed to get 65 back at this point due to the protection of the put, so the max risk currently is 381 or 5.5%, and we do have an infinite upside profit potential. Right now, well, before the earnings came out on March 2nd, we could liquidate for a small profit of about $210, $190. Had we liquidated, we would avoid the risk of a down earnings, where we might be taking a loss on the position, but we may also miss out on a positive earnings and further upside as well. Can we reduce the risk on this position going into earnings? Well, there are multiple ways to do that. The common approach: we've got a stock, we've got a put position, let's just sell a call, what we refer to as income method number 1. This is introduced in the free white paper known as the Sketch, which you can get at RadioActiveTrading.com, but it's detailed fully in the blueprint, the full course on proper limited risk trading and the 12 different income methods. We could sell a March, only 16 days away, 70 call for $265. The premium is really high due to the earnings event coming up. This cuts that 5.5% at risk we had, or $381, down by more than half. So we'd only have a downside risk of $116, or 1.8% on our investment. It gives a high potential profit if DAR is trading right at $70 on March expiration after the earnings comes out, with a max potential profit around 8.2%. But the upside is capped. If the stock gapped up to 75 or to 80, we give some of that profit back due to the obligation of the call that's now in the money and is going to a delta of 1, as the put's still losing value as the stock increases in price. So this can reduce the risk, but going into the unknown events such as earnings, we may not want to cap that upside profit potential. Are there other ways to reduce risk? Well, absolutely. You know one of my favorites, what we call income method number 4. This is where we use the put option, which is not a wasting asset. It's actually a second asset that we can manipulate to our advantage. Even though the stock's at 67.95 or so, that April 65 put that's out of the money has not gone to zero. In fact, it's inflated as well due to the earnings coming up on March 2nd. So we had an opportunity to sell to close the April 65 put for $365. And we can move up and buy to open a 70 strike put for $625. Now, this is going to cost us $2.60. That's going to add into the cost basis of the position. But at the same time, we're going to gain 5 points of guaranteed exit. We increase our cost by $260, but we're able to get out at 70 now instead of at 65 in the worst case scenario. So the risk drops down to only $141, or 2% going into earnings. And the upside is left open. If the stock goes to 75, we're still going to be at about a $400 profit, double what we have for liquidating before the earnings. And if it shoots up to 80, 82 or 83, we're looking at an $800, maybe $1,000 in profit on this position. If one works one way and the other works the other way, can't we do both? Of course we can. This is why the blueprint contains an entire chapter on combining income methods. We saw that we could cut the risk to only 2% with income method number 4. And if we dive in and sell that March, remember only 16, 17 days away, 70 call that's inflated for 265. We now have a bulletproof position going into earnings. The max risk is now negative 124. What does that mean? A guaranteed profit even if the stock collapsed to $55, $50 per share, or 1.8%. We still have that upside potential of about a 7.6% return if the stock's trading right at 70. Notice what's missing from this graph as well. We see the current stock price, but there's no break-even listed that we saw with the other trades. And that's because it's a bulletproof position. The stock could go to 0, we'd still make the 1.8%. But the upside is still capped. So if we see a large unexpected and positive gain in DAR, we're going to miss the upside even though we have a bulletproof position and a potential for a strong profit if the stock's right at 70. So can we cut the risk down, get income as we did with income method number 1, and leave the upside open? Absolutely. Another income method number 6, solves that capped upside of income method number 1. We don't get as much premium as we would by just selling the call, but we leave the upside open while still reducing the risk. Here we'll still sell that March 70 call at 265, but now we're going to buy the March 75 at $1.20. By itself, that looks like a bear call credit spread. But combined with owning the stock in the proper protected position, this is just a covered call with an extra long call to leave the upside open. We only get $1.45 of net credit as opposed to $2.65 by just selling the March 70 call. By itself, this would take the risk down from 5.5% down to 3.5%, and it leaves the upside open in case the stock does go beyond our expectations. It goes to 80 or 85. We're still looking at potentially an $800, $900 profit in those scenarios. So it's not bad, but it didn't get us to bulletproof status and it didn't leave the upside open. But as we combined that income method number 1 with the income method number 4 to satisfy our needs, let's combine 4 and 6. We reduced the risk by rolling up the put option to get only that 2% risk that we saw originally. Then we add the income method number 6 position, get another $1.45 in net credit, which cancels the risk to the downside, only to about 0.1%. But that's if the stock really collapsed down below $50, $45, $35 per share, a no-risk trade. We still have a strong potential profit if the stock's at 70, a profit above our current liquidation if it's between 70 and 75, and if it exceeds our expectations and goes up to 80, 82, or $85 per share, we're back in that $700, $800, $900 profit range that we saw before. Combining these income methods as described in the blueprint allows us to cancel the risk going into earnings, leave the upside open, and still be able to generate strong profits and a variety of different stock prices after the earnings event. Well, how to choose which combination? Well, that's why there are 12 income methods for different market situations, and each income method against that protected position is fully described in the blueprint. The SIGA model for each income method is detailed as well. What are the current conditions? I've got a low risk position heading into earnings that I could liquidate now for a small profit, but I don't want to miss potential upside. Expectations, in this case, it's an unknown. Earnings could disappoint and the stock could fall, so I want to make sure I have a guaranteed profit to the downside, or it may exceed my expectations and shoot up to higher prices, so I want to leave the upside open. Goals: take advantage of the upside that might occur while canceling all the risk to the downside. That determines the action. Now, you would choose which income method or combination best suits your goals and expectations for your positions. And it's great to have these options to bulletproof a protected position before earnings, leave the upside open, or potentially bulletproof at any time. And you want to check out the blueprint, just go to radioactivetrading.com, click on the products tab. You can read the full description of the blueprint, take a look at the table of contents, and even listen to the first chapter. Over there at radioactivetrading.com as well, you can just put in your name and email address to get full access to that 9-page white paper, the sketch which introduces the proper protection, and examples of income method number 1. Now, Blueprint owners, existing Blueprint owners and Fusion subscribers are going to see more details on this trade and this analysis soon. We're going to compare the outcomes of the different adjustments for our Blueprint owners and Fusion subscribers, what worked best, what could have worked better, and what gave us the best scenario to take advantage of our expectations and our goals. And of course, in that later discussion for Blueprint owners and Fusion subscribers, we'll even discuss the why and how we might even have set up a position that looked like this going into earnings to be able to potentially profit to the downside without having any real risk and still leaving the upside open.